Let me tell you the most common mistake physicians make when they start thinking about moving states. They Google California versus Texas income tax. They see the number, their jaw drops, and they start calling real estate agents in Austin or Tampa before they'd even run the full math. And I get it, I really do. When you're earning $500,000 a year and someone tells you that one state takes $45,000 of that and another state takes zero, that feels like the conversation is over before it starts. But here's the thing, the conversation is not over. It's barely begun. Because physicians are not just wage earners. We are not a family making $80,000 a year with a straightforward W-2 and a simple tax return. We are high-income professionals. We are homeowners, investors, and sometimes partners in surgical centers, owners of LLCs, holders of rental property, recipients of K-1 income, and other income from group practices. We exist in a legal and financial environment that is completely different from the average American household. And that means we cannot use the average American framework to make this decision. So today, we are going to do something different. We are not going to just compare income tax rates. We are going to do a full stack analysis, and I mean layer by layer across California, Texas, and Florida. And we are going to use a real, concrete example so this doesn't stay abstract. Here's a scenario. Take an anesthesiologist, married, filing jointly, earning $500,000 in W-2 income. Earning $500,000 in W-2 income, homeowner. In California, that home is worth $1.5 million. In Texas and Florida, the comparable home is comparable metro area is $900,000. Those numbers are realistic. Metro adjusted equivalents for a physician household trying to live a similar quality of life in each state. Now, let's walk through every single layer so that by the end of this, you have a complete picture. Okay, let's start with the one everyone already knows about, state income tax. California has a progressive state income tax. At $500,000 of household income, you're sitting firmly in the upper brackets. After standard deductions and depending on your filing specifics, you are looking at somewhere in the range of $40,000 to $50,000. Let's just call it $45,000 in the middle. That's all going to Sacramento every single year, just in state income tax. In Texas, that's zero. There's no state income tax. In Florida, also zero. No state income tax. So on this one line item, California loses. And it's not even close. If we stop the analysis here, Texas and Florida would win in a landslide. And this video would stop right here. But we're not stopping here. Here's one that doesn't show up in the headline comparisons because it shows up on our pay stubs every single month. California has state disability insurance, also called SDI. And as of recent changes, that withholding is 1.3% of your wages with no wage cap. So on $500,000 of W-2 income, you are losing another $6,500 per year. Quietly off the top before you see a single dollar. Texas has no equivalent statewide SDI. Florida has no equivalent statewide SDI. So now we're at $45,000 in income tax plus $6,500 in SDI. So roughly $51,500 behind compared to a zero income tax state, just from the two layers. It still looks rough for California, but let's keep going. Let's talk about property taxes. This is where it gets really interesting. Most people assume Texas and Florida are low tax states, full stop. And when it comes to income tax, that is true. But property tax, that's a completely different story. California operates under Proposition 13. Your property is assessed at purchase price, and annual increases are capped at 2% unless the property changes hands. The effective rate is roughly 1% of assessed value. On a $1.5 million home, you're paying approximately $15,000 per year in property taxes. Now let's look at Texas. Texas runs much higher property tax rates, commonly 1.8% to 2% effective, heavily driven by school district levies. On a $900,000 home and 1.9%, you're paying about $17,000 per year. You heard that right. A Texas homeowner in our scenario is paying more in property taxes than a California homeowner on a less expensive home. Florida lands somewhere in between depending on the county and homestead exemption status. Let's call it 1.3% effective on that $900,000 home, roughly $11,700 per year. So let's put that on the board. California, $15,000 in property taxes. Texas, $17,000 in property taxes on a cheaper home. Florida, same thing, $11,700 in property taxes. Suddenly, Texas doesn't look like a low tax state. It just moved the burden, swapped income tax for property tax. And Florida, while friendlier in property taxes, is not zero either. This matters enormously for a physician who is going to be in that home for 10, 15, 20 years. That property tax compounds over time. Now, if you're purely W-2 with nothing else going on, this section applies less to you. But in my experience, that's not most physicians at the $500,000 income level. Most physicians at this stage have something else going on. Maybe it's an S-corp set up to run a side practice or consulting income. Maybe they have rental properties sitting inside LLCs. Maybe they have equity in an ambulatory surgery center generating K1 distributions, for example. Maybe it's all three. California imposes an $800 minimum franchise tax on corporations and LLCs just to exist, even if you make no money. It also levies a 1.5% S-corp tax on net income at the entity level, on top of the personal income tax. If you've got an S-corp generating $200,000 in net income, that's another $3,000 gone before it even hits a return. Texas has a franchise margin tax at the entity level once you cross certain revenue thresholds. It's a different structure, but it's not nothing. Florida has a corporate income tax of 5.5% for C-corps, which matters if your entity structure doesn't qualify for pass-through treatment, which is true of C-corps. None of these numbers alone are catastrophic, but they are recurring. They're annual, and they add friction to every business decision you make. Every time you form an entity, every time you bring in a partner, every time you restructure.